A great evening, everyone. Warm welcome to Business Live. Coming up in this edition, government kickstarts process to restructure local dollar bonds and cocoa bills, insisting it needs to drastically reduce Ghana's debt and unlock additional funding from the IMF. Also in this bulletin, consumers urged to prepare to bear the extra cost on fuel prices as oil marketing companies increase prices of petroleum products at the pumps.
The consumer has to always pay for the price, the market price. Once it goes up, you have to pay what the market is dictating.
Plus, second edition of Joy Business Thought Leadership Series comes off tomorrow at 1 p.m. We will tell you what to expect. We've got details of these and many others coming your way, all in a moment. Please stay. Always a joy to have you on. I am Pius Kojobaka. To our very first story, some oil marketing companies have increased prices of petroleum products at the pumps beginning this morning. However, the reasons for the increase have been mixed. While some are linking to the cost price of the bulk oil distribution companies, others are also attributing it to the slight depreciation of the cedi to the dollar, basically. George Biafe has the rest of the story.
Total Energies is selling a litre of diesel and petrol at 12 Ghana cedis 45 pesos from its old price of 12 Ghana cedis 30 pesos per litre. Market leader Govt is selling a litre of diesel at 12 Ghana cedis 45 pesos, while petrol is going for 12 Ghana cedis 40 pesos from its old price of 12 Ghana cedis 30 pesos. Now, 12 Ghana cedis 45 pesos, that's the price that Shell is selling a litre of diesel at the pumps. However, petrol is going for 12 Ghana cedis 40 pesos. This should mean that prices have gone up by 10 to 15 pesos per litre in terms of increase in prices of petroleum products from this morning. However, reasons have been mixed. Whilst some of the oil marketing firms are linking the adjustment to an increase in the cost price of products sold by the bulk oil distribution firms, some of the firms are linking the adjustment to the recent challenges with the Ghana cedi. However, officials of the National Petroleum Authority are disputing this, insisting that the Ghana cedi has been fairly stable since last month. The bulk oil distribution firms have been explaining to Joy Business why their cost price have gone up. They are attributing this to an increase in prices of finished petroleum products on the international market. It's not clear for now how this could impact on transport fares as well as the general price levels of goods and services in the coming weeks.
Now, Executive Director of Africa Center for Energy Policy, Ben Boache, has indicated that the increase in fuel prices by the oil marketing companies is a major surge and does not require the intervention of government. According to him, consumers must be prepared to bear the extra cost. He spoke earlier on the marketplace.
The government can hardly intervene. If we understood what the group oil was delivering, then we can look at how that intervenes in this particular instances. But if you check the price build up now, currently, you're looking about 2.3 cedis. Even if they take all of that out, petroleum prices will still be as high as above 10. So there's little room for government to intervene at this point. The consumer has to always pay for the price, the market price. Once it goes up, you have to pay what the market is dictating. And when it comes down also, that is the fuel of the world, and consumers always have to be aware that the movement has to be absorbed by the consumer. So I think it's just the usual preparedness to recognize that international oil prices are not stable. It goes up and down, and when it goes up, you have to prepare to pay more, just as when it comes down. The only time you expect such huge intervention will be when it's so significant that it throws the entire economy off balance. Then you expect some policy action to really offset any economic difficulty. But at this point, I don't think it's a major concern for us in the industry and also for the government.
And to some other stories, the World Bank has warned Ghana that it faces risks of financial challenges and the tendency of losing its foreign direct investment inflows to other countries if this does not implement a critical action plan to address its current energy challenges. According to its Managing Director of Operations, Anna Bejedi, the issues confronting metering, billing and revenue collection within the sector should be proactively done without interruption. Addressing the media at a press conference, she said her outfit will provide technical support to the government and other stakeholders to save the sector from going down.
The World Bank Country Director in its earlier remarks said that deficiencies in the energy sector is being characterized by the power purchasing agreement, which is gradually driving Ghana's debt up.
Those contracts that you've signed, those PPAs, are just too expensive. Too expensive, and the kind of PPAs you sign is take or pay, which means Ghana is paying to the electricity that is not even being produced.
Yeah.
You have double capacity. Yes, over time, usage will improve, so your excess capacity will go down. But the fact is, in the last few years, Ghana entered into some PPAs that were the wrong types, in our view, and at the wrong rates, at the wrong prices, and today you are paying dearly for it. And also it has an impact because today we're talking of clean energy.
Yeah.
Many companies want to come to Ghana to do solar and all. Yeah, government wants probably the best thing to do, but you are still caught up with those that you have to pay because you are tied up in these contracts. So you will take new ones, you will pay.
Now, the bank's Managing Director of Operations, as part of its 3-day working visit to Ghana to deliberate on ways to support Ghana's economy, said an immediate action is needed to save the energy sector as well as businesses.
During COVID, of course, was very important, but it's also very important as Ghana takes on some of these reforms. So some time ago, the tariff was increased quite significantly, the electricity tariff, and that can only be done when you have also an accompanying social protection system that takes care of some of the lower income households to be able to absorb the higher cost of electricity. And then the third area is the energy sector in and of itself. There's been, over the last few years, a deterioration in the performance of the energy sector, particularly in the financial performance. And here we're trying to help with metering, billing and collections so that the revenue collected from the sector can go to where it needs to be, covering costs so that the energy supply is not interrupted. So that's a very big part of our dialogue right now. And it actually is linked to us also providing support to the budget, because we very much would like to support the government's actions to improve the energy sector as part of our budget support initiative with the authorities.
She maintained that there is a need for more investment for renewable energy.
Yeah, we talked about is actually starting to shift from conventional energy to renewable energy. We see huge potential in solar energy, for example. And around the world, what we have seen is when countries shift to renewable energy, you do need to make the commensurate investments also then in transmission equipment, because it requires investments to be able to accommodate renewable energy technology. But what we see is that you all of a sudden get a very big new business line in services for renewable energy, which stimulates growth. You can even think about developing what we call local manufacturing capacity so that you get certain new areas of growth. So we see a lot of opportunities with the green economy, and I think a lot of opportunity to think about the energy strategy also going towards green and interconnected to be able to export to other countries that need energy through the West African Power Pool and other interconnections. Ghana has huge potential in this field.
Also, Country Director for the World Bank, Pierre Laporte, reiterated the bank's commitment to supporting Ghana's economic reforms.
In terms of what's in the pipeline, as you know, we are working on a budget support operation for $300 million that we expect to be approved before the end of the year to support the economic reform program. We also have a financial sector support operation of $250 million also expected before the end of the fiscal year. As you know, with the domestic debt restructuring, this impacted on the capital adequacy of banks, and we are coming in also to support that as part of the broader reform. And then we have several projects like this in the pipeline in terms of investment. We have a youth entrepreneur youth employment program being in the last phase of preparation.
According to the World Bank, growth is expected to slow further to 1.6% and remain muted in 2024 before returning towards its potential.
James Ishen filed that report. Now, Fitch Solutions has reaffirmed its position that economic activities in Ghana will get worse before getting better this year. This is coming despite the expansion of the economy by 4.2% year-on-year in the first quarter of this year. According to the UK-based firm, the relatively appreciable growth rate in the first 3 months of this year was primarily driven by strong government consumption as tax revenue shot up significantly. Fitch Solutions had projected that the country's budget deficit will narrow substantially to 5.7% in relation to the size of the economy in 2023 from an estimated 8.3% in 2022. Here is Mike Koroninga, Senior Country Analyst for Sub-Saharan Africa, speaking on the mid-year review of Sub-Saharan Africa.
Acceleration in the first quarter of 2023 was primarily driven by strong government consumption and a widening trade surplus as exports remained pretty solid while imports faltered. That said, household consumption essentially recorded no growth at all, and fixed investment recorded a pretty significant contraction, implying that domestic conditions remain weak and that growth will likely soften in the quarters ahead. We project real GDP growth to average 3% this year, remaining well below Ghana's pre-pandemic average of 5.3%, which is indicated by the pink line here. So naturally, the next question is, why is this the case? So why will Ghana's economy operate below capacity in 2023? And one of the key reasons here is weaker access to credit.
All right, so let's stay a while longer on the economy because government has finally kickstarted the process to restructure local dollar bonds and cocoa bills totaling almost 18.2 billion cedis. This was after it officially launched what is being described as the second round of the domestic debt exchange program. George Yafe has the rest of the story.
For the local dollar bonds, which is directly being led by the Finance Ministry in terms of the offer, government is seeking to restructure $809 million worth of bonds. Investors that are holding these papers have from last Friday to July 28, 2023 to take a decision whether they want to participate in the offer. However, the Ministry of Finance have already secured the necessary commitment from commercial banks and some institutional investors that hold majority of these papers. But one is still not sure whether the offer could be successful come next Friday. The Ministry of Finance is hoping that the new dollar bonds will mature on 2 separate years. 50% of the payment to be done in 2027 and the rest in 2028. The cocoa bill, which government is seeking to restructure almost 8 billion Ghana cedis, is led by Bank in terms of handling the whole process. The offer will close by July 31. Holders of these papers that decide to participate in the offer will have each bond exchanged for 5 new papers with an aggregate principal amount rounded up to 1 Ghana cedi. The Ministry of Finance argues that it needs to carry out this second round of domestic debt restructuring to help reduce the country's debt and unlock additional funding from the International Monetary Fund.
All right, so joining me on the back of this is economist Professor Lord Mensah, who joins me on phone. I'm grateful you could join me, sir, on Business Live. What is your expectation of this new DDEP for dollar bond holders? Basically, do you anticipate similar resistance like what we saw the previous one?
I think the previous one has laid the foundation, and clearly the investor community has started learning some of the consequences that if you don't subscribe to the new issues that government proposes, the problems you are likely to face. From where I sit, decisions have come this far. You look at cocoa bonds. If you look at the country that is running on, debt. I can say that the IMF program, calls for a debt restructure, and it's
something that we should have expected because the main target on government balance sheet is the interest payment, which has taken about 55 more than 50% of our expenditure. So it is expected that before government get that kind of free space, they may have to look at debt restructuring. And that's why we started with the domestic debt. And then the foreign debt, I believe that the domestic debt has laid that foundation for the investor sensitization. And I don't think the government will struggle with the current one as expected, even though, they all come as a shock to the investor community. And for me, the investor learns, and anything that happens sometimes gives them kind of leverage to accommodate, the possible happens. And as we speak now, every investor in Ghana knows that government bonds are not risk-free. And so if this restructuring are coming, yes, it's something that they may have to embrace. But then, if you listen to the statement that was issued, a government says it's voluntary. And if it's voluntary, some may want to test the water by holding up, their old bonds. But like I indicated earlier, it's not going to be that difficult as compared to the earlier one.
In your view, how crucial will this exercise be to meeting the conditionalities, basically to qualify for the second tranche of receiving the IMF program?
Yeah, critically, the first tranche, let me put it, it was more or less an emergency tranche. It is a tranche that, the external or the IMF saw the dire consequence of our economy. And as a result of that, they had to relax some of the requirements. And so I believe that with the second tranche, they may strictly, keep to the requirements. And one of the requirements is to make sure that we reduce our debt burden. And remember, IMF does not lend to a country that is in debt distress. And so if your debt burden will be hindering, the possible benefits that you're supposed to gain from the program, they may not go on to extend, the facility. So the first one is more or less a rescue, relief. And the subsequent ones, I believe they will go strictly by what is. So it's quite, a pressing issue as far as our engagement with the IMF is concerned.
It's good you mentioned about our debt stock, and I want to know the importance of this exercise in reducing that, really.
Yeah, of course, it's not going to reduce the debt stock. It's a reprofiling. It's just going to prolong, our debt payment. But then, in the immediate term, there's going to be that fiscal space because government interest burden will come down. So let's assume that if you have to pay, 19% on the maybe it's low. Let me put it 6% because those bonds, international bonds that were, issued locally, were going for 6%, 7% thereabout. And so if you're able to reduce it maybe 2% for about 10 years, it creates that kind of space for government to maneuver with the possible, interest payment that they would have done. And so from where I sit, it's just a deferment. And if we don't package ourselves well and we don't take advantage of the free space, economic space, the fiscal space that will be created within this period that will be warming up to pay the principal going forward somewhere in 5 years, 10 years time, it may be a big blow to us. And so from where I sit, I think we may have to be careful, as much as we are reprofiling, we should note that it's not going to reduce our debt, but then rather defer our debt into latter years of, some of us, our life. And I think with that, we can get that fiscal space to operate and generate more to pay going forward.
Okay, so Professor Amensah, do you hold the view that this exercise basically is better off for investors?
Well, from the investor's perspective, if you are going to lose your money completely, let's assume you don't accept this and government, But then the only problem with government is that in as much as the investors are going to sacrifice, they may want to see the government behaving like a government that owes, not necessarily a government that, squeeze the people, and in the end, the government will be, flushing, things out and then wasting money here and there. But from where I sit, right, and from the principles of finance, if you are going to lose your money completely through, banks, if the country should declare bankrupt, then you are better off that the country will restructure, and then possibly prolong your debt. So from where I sit, I think it's an offer that we may have to consider as investors, and then possibly sacrifice in a short to medium term for long term, prospects for the country. So I think it has to do with communication as well. And if the communications are not clear, that is when the investor community, seem to lose trust in the government. And when they lose trust, whatever you put on the table, they will take it with a pinch of salt.
All right.
But if you, turn up to come out clear with information, if it comes about that you have to pay, certain principal and certain coupons, and you need to pay it exactly on time, I think you build that trust with them, and whatever you put on the table has to do with negotiation.
All right. Thank you very much, Professor Lord Mensah, for your time here on Business Live. You're still watching Business Live with me, Pius Kojo Baka. We've got more for you after this break. Hello, welcome back. The government achieved about 19.5% of its Treasury Bills sale target. However, the cost of borrowing the domestic instrument went up for the 15th consecutive week. There is more in this report.
The auction was oversubscribed due to the relatively smaller target. According to the results published by the Bank of Ghana, the government got a little about 2.12 billion cedis from the sale of short-term instruments. The target for the auction was estimated at 1.77 billion cedis. A chunk of the bids came from the 91-day T-bill, where a little above 1.81 billion cedis were mobilized. The government, however, accepted all the bids tendered. Again, the government accepted all the 313.59 million cedis tendered for the 182-day bill. Meanwhile, interest rates continued to surge as the 3-month bill increased by 0.29% to 24.39%. Also, the rate on the 182-day bill shot up to 26.40% from the previous 26.02%. Analysts are concerned about the rising interest costs as it may affect the government's quest to cut domestic interest payments.
And we do know tomorrow is a big day for us. Despite swearing never to return to the International Monetary Fund after the 16th program for a bailout, Ghana returned to the fund for a 17th program. Well, this was after the economy went through external and internal shocks coupled with fiscal indiscipline, sending it to its knees. Now, the effects, a painful debt restructuring program and aggressive tax reforms have brought untold hardship to businesses and consumers. Expectations are high as the government prepares its 2023 half-year budget. What are the expectations of businesses and industry? This edition of the Joy Business Thought Leadership Series will seek to examine the impact of Ghana's 17th IMF program and the government's policy initiatives to revive the economy in the mid-year budget review. We've got great speakers, Professor Govt, economist and professor of finance at the University of Ghana Business School, and great industry players to speak to the issues tomorrow. You just want to make a date with us tomorrow at 1 p.m. on all our social media platforms and, of course, on all our platforms, Joy News and myjoyonline.com, as well as 99.7 FM. This is where we part company. I am Pius Kojo Baka. Let's connect same time tomorrow. Bye.